This is Al Brooks. Thank you for watching the Brooks Trading course. This is the first of 5 videos on wedges. In this video, I'm going to discuss what I mean by the term wedge. I use a broad definition to include just about any pattern that has 3 pushes, whether or not the pattern is convergent. This is a continuation of the list of reversal patterns that I've been discussing. And like all of the other reversal patterns, even wedges involve some type of trading range. For example, a final flag, or after the wedge reverses, is often a major trend reversal, which is usually part of a trading range. I always think of wedges as either a flag in a trend or as part of a reversal. For example, we have a pretty strong breakout here, and we have a bull bar, and then a second bull bar that led to a small reversal, and then a third bull bar. This is a wedge bear flag. It does not matter that the beginning of the bear flag began before the bull trend ended. That's common for the market in transition from a trend into a trading range or a trend into an opposite trend, for the transition to begin before the trend ends. Wedge bear flag is a pullback, and that means chances are the bear trend will resume. A bear flag is a small trading range or a small bull trend. A breakout above a wedge bear flag is a reversal into a small bull trend. A wedge top is a reversal of a bull trend. We have a bull trend, and we have 1 push, 2 pushes, 3 pushes up. The trend line and the trend channel line are converging. It's a convergent channel. We got a bull breakout above the channel, and now we are reversing down. So a wedge top is a wedge reversal. A wedge bear flag is a pullback. Every bull channel is almost always a bear flag on a higher time frame chart. And a bull channel, 75% chance you'll get a bear breakout, either by going down or by going sideways. And then the market evolves into a trading range. And therefore, a bull channel is ultimately a bull leg in what will become a trading range. A wedge is simply a triangle where the triangle is sloped upward or sloped downward. There are often different ways to draw wedges, and wedges are often nested, smaller ones inside of larger ones. We have a bull breakout, a pullback, second bull breakout, pullback, and then a third rally and a reversal down. Some computers see the wedge as 1, 2, 3. Other traders see it as a larger wedge, 1, and then 2, and maybe 3. It doesn't matter as long as you understand what's going on. The market keeps trying to break to the upside and failing. You could say we have a strong bull trend here and then a bear breakout. I did not draw the trend line. And traders will look for a resumption of the bull trend to fail. In this particular case, this is a wedge, higher high, major trend reversal. This, on the other hand, is a pullback in a bull trend. It's a wedge bull flag. You expect the market to resume up. Here, you expect the market to reverse down. This is a small bear trend within a larger bull trend. A triangle that's sloped upward, 1, 2, 3, 3 pushes up in a trading range. It's a triangle. It's sloped upward, so I use the term wedge. Convergent lines, you can call it a bull channel or you can call it a wedge. A rising wedge is a potential top. A bull channel, a wedge bull channel, is usually a bear flag. The odds are you get a bear breakout. There's overlap here. The breakout above this high, pulled back below the high. The breakout above this high, pulled back. The breakout above this high, pulled back. When you have a wedge channel where there's overlap, there's higher probability that you'll get the bear breakout. We're trying to get a bull breakout above the top of a bull channel. 75% chance that fails within about 5 bars, and you get a test of the bottom of the channel. That's not saying much when the bottom of the channel is so close, but given the entire picture, the bears might be able to get a test to the bottom of the channel, or even possibly a bear trend. Here we have a reversal bar, a close below the midpoint. It's only a doji, but it is a reversal bar, and it's a reasonable sell. Traders will sell with a stop just below the low of that bar and get filled here. Pretty good looking entry bar for the bears and very good looking follow through. This bar is even bigger than that bar and it's closing on its low. It looks like the market's going lower. A series of consecutive bear bars closing on their lows. Strong breakout, probably at least some kind of a measured move down. The goal is, after a wedge top, a swing down. 10 bars, 2 legs as a minimum reasonable goal. This could be the first leg and then a small pullback, second leg, or this entire move down might be the first leg. And then the market might get a larger pullback and a larger second leg. Remember earlier I said there were different ways to draw this wedge. Some computers would say the top of this breakout is the first push, and maybe this is the second, or they might say first, second, third, and fourth push. They may say the wedge channel has 4 pushes up. Nested wedge, I view this as a large first push up, a pullback, second push here, and then pullback, and then the third push subdivides. So it's a nested wedge, a smaller wedge within a larger wedge that has a higher probability of leading to a reversal. A wedge top, it's a climax, and like all climaxes, it usually leads to at least a pullback, or at least a pause in the buying. Climaxes can last a long time. A series of bull bars here, 5 bull bars, climactic move here, a series of strong bull bars here. The rallies within a wedge top are often strong enough often to be a buy the close rally. Traders will buy closes, confident that the market will go at least a little higher. The same with here. It's a buy the close rally. And here as well, even though the bars are small through here, these are buy the close rallies. At this point, look at the pullbacks. Only 2 bars down here, 1 bar here, 1 bar here, 2 bars here. We have a part of the large wedge that is also a small pullback bull trend, which you can call a short squeeze. The shorts are getting squeezed. The bears who keep selling reversals are being forced to buy back their shorts by bulls buying below the lows of the bars, more buying than selling. A small pullback bull trend is also climactic and unsustainable, and therefore it's appropriate that it's occurring within a wedge, which is usually made up of a series of climaxes. Small pullback bull trend, it's a FOMO trend, fear of missing out. The bulls are buying because of momentum rather than because of fundamentals. They're not buying up here because it's cheap. They're buying up here because the market's going up and they think it'll continue up because the pullbacks are small. FOMO trades, fear of missing out trades, are crowded trades. Everyone's long, and once traders start to take profits, everyone exits in a panic. It just takes a couple bars here to make all of the traders who bought during the last 10 bars now holding losing positions, and they're going to be very quick to get out. That happens all the time with crowded trades. When too many traders are long, they're going to be quick to get out. They know they're buying based on momentum, and as soon as the momentum ends, everybody is going to be quick to exit. We have a bear breakout, first push down, second push down, third push down. You can call this a first push, you can call this, you can say this is a wedge, 1, 2, 3, and the bottom did not lead to much of a reversal. You can call this a wedge. Bear trends are always forming wedge bottoms. Bull trends are always forming wedge tops. This is a wedge because it's a bear channel, a wedge bottom, it's a bear channel, and the lines are converging. We're getting overlap. If you're looking for a wedge bottom, you want overlap. You want the pullback from the second leg to go above the low of the first leg. That increases the chances that if you start to get a reversal, it'll be a successful reversal. You can draw a channel line. We have a reversal up, a reversal up. You can draw a line. And here we're breaking below the line and we're reversing up. Failed breakout below the bottom of the bear channel. That's good for the bulls. Strong reversal bar. A little bit of a micro double bottom. This bar went down and up, and then we went down here and then up here. Good for the bulls. Bulls will buy above the high of that bull bar or the high of this pullback bar. The goal of the reversal is 10 bars, 2 legs. Approximately. It could be a lot more, usually not much less. So first leg up, pull back, second leg, or a complex first leg up, pull back, second leg. Another goal in a wedge reversal is a test of the top of the channel, either here or here. And ultimately, we reach both. Whenever you have a sell climax like this and then a reversal, one reasonable target is to get just a little bit above that high, which we got over here. The goal of every market is to find a price that will attract the most trading. A fair price, a price that the bulls find good for buying, the bears find good for selling. And to find that fair price, it's constantly changing. There's constant information coming into the market. Every fair price is constantly changing. The market usually has to go too far one way to find out how far enough is. And that's what happens with a wedge bottom. The market's probing for a bottom, and then at some point decides it has gone too far, and the fair price is probably higher. So it reverses up and starts probing in the opposite direction. You see 3 pushes down, and the legs down are getting smaller. Plus you see overlap. The pullback from the second leg goes above the low of the first leg. There's less interest in lower prices. The market sees the buying pressure. They see that the bulls who buy at this low can make money. They assume the bulls who buy at this low will make money. Less interest in buying lower. The reversal attempts are coming after fewer bars. The bears are deciding that this price is too low to sell. They only want to sell higher. And the bulls believe that the market fell too low and that it's a good value, and they start buying. They start buying below bars, and then they're starting to buy with stops on reversals up, confident that we've gone too far down. Both bulls and bears buy. The result is a reversal. Usually, when you get a reversal, you get a couple legs up because you get trapped bulls and bears. You have bulls who did not buy initially. They're trapped out. They're hoping for any kind of a pullback to buy. That results in a second leg up. And you have bears who did not get out on the reversal up, and then they see this and they decide, okay, it's going higher. And they look for any reversal down so they can buy back their shorts with a smaller loss. The result is you have bears trapped into shorts, and they're looking to get out, and they buy. You have bulls trapped out of a long. They're hoping for any kind of a pullback, and they buy. The result is a second leg up. We're selling off here. Not all that strong. Big bear bar, small bear bar, pair of bear bars, bull bar, bear bar, doji. This looks like a bear leg in what will become a trading range. You have to think that we have a little bit of overlap here, so a negative gap here. It's also a small pullback bear trend. And that has an element of long liquidation. Bulls keep buying, and they decide they bought too soon, they have to sell, they have to liquidate. And that's happening repeatedly here. A tight channel, a small pullback bear trend, that is climactic. Here it has a series of small sell climaxes. A wedge bottom usually has different types of sell climaxes within it. Here we have a 5-bar sell to close type of sell climax. These bear trends can last a long time, and they can create a pain trade. Bulls see what they believe is a weak, broad bear trend, and they keep buying. However, they keep buying and they keep losing, and they start to feel a lot of pain. A pain trade is a low probability event, and that just goes on a long, long time. You look at it and say, wait a minute, how can this suddenly be getting so much stronger when we had bad follow through all through here? The bulls see this reversal up. They start assuming we'll get a major trend reversal, yet the market keeps going down. So the bulls who are buying are experiencing a lot of pain, and pain trades usually have at least two legs, one pullback, two. Sell the close. It's a FOMO trade, fear of missing out. The bears sell not because the market is expensive. They sell because it's going down, and they believe it'll go down at least for a small second leg. And the result is they're not selling because of fundamentals. They're not selling because the market's expensive. They're selling based on momentum. And as soon as the momentum stops, everyone is trapped into shorts and they suddenly give up. It's a crowded trade. Too many traders short. And once the momentum down ends, the bears buy back in a panic. Crowded trades often lead to sharp reversals. The bears give up. And when you get these sell climaxes, the trades are usually crowded. Too many traders short. Remember, a wedge is simply a triangle that is sloped up or down. And a triangle has three pushes up or down. As soon as I see three pushes, here up, one, pullback, two, pullback, three, I think this might be a wedge top. And higher probability of a reversal if the lines are converging, as they are here. There are always multiple ways to draw patterns. I'm picking this. Some computers will say this is the first push, second push, third push. Here we have three pushes up, one, two, three. It's a triangle. And since it's mostly horizontal, traders would refer to this as a triangle rather than a wedge. There's also a bear trend, bull breakout, higher low, major trend reversal, and a double bottom, higher low, major trend reversal. Traders buy for the reversal up. You can also call it a head and shoulders bottom, left shoulder, head, and then right shoulder. And the right shoulder formed a double bottom. If you have a channel, you have a pair of lines. If they're sloped up, it's a wedge. And it can be a bear flag and a bear trend, or it can be a top and a bull trend. Here we have a wedge bottom. Does not look like a wedge, but it is. We have three pushes down, one pullback, two pullback, three. A small double bottom created the first two pushes, and then the third push here. Again, different computers use different reversals to create the lines. Some computers will say the wedge began here. Others will use the pink lines and say the wedge began here. Some will say we had a wedge top here, one, two, three. It tried to reverse down and failed. And then we broke to the upside, and the breakout above the wedge is failing. Another way to draw this wedge bottom, one, two, three. Whenever you have a wedge, you assume there's going to be a 75% chance that you'll get a breakout in the opposite direction. A wedge bear flag, you expect a reversal down. A wedge top, you expect a reversal down. Wedge bottom, a downward sloping wedge, you assume you get an upside breakout. A rising wedge, 75% chance you'll get a break below the bottom of the wedge, either by going sideways or by going down. Whenever I see a bull trend, whether or not it's a wedge, if it's in a channel like this, I think of it as a bear flag because I know the odds are there'll be a bear breakout either into a bear trend or into a trading range. A falling wedge, a bear channel, 75% chance there's going to be a bull breakout. A triangle, 50% chance you'll get a downside breakout, 50% chance you'll get an upside breakout. 50% chance the first breakout will reverse. We have a triangle, we have a bear breakout, and it reversed. Is this a wedge top or a triangle? This high is slightly above that. This high is slightly above that. We have 3 pushes up. However, the pattern is mostly triangle. What do you call it? A wedge or a triangle? Doesn't matter. The forces are the same. 3 pushes up. In a channel, convergent, 75% chance in general. If it's a wedge, 75% chance you get a successful bear breakout. The flatter it is, the more it's a triangle. 50% chance you get the downside breakout. 50% chance you get the upside breakout. The bulls tried to get an upside breakout, and we see a decent sell signal bar. It's a reasonable short right below the low of that bear bar, betting on a failed breakout above a triangle or a failed breakout above a wedge. We're breaking below the bottom of the pattern. Is this a failed breakout? We're trying to reverse up, trying to reverse up? Well, it is. However, it's also 5 consecutive bear bars. Chances are there are sellers above, and we'll get at least one small leg down. The bears therefore see this as the start of that second leg down, and they see this as a bear flag. They see the whole thing as a bear flag. We have a bear bar, bad follow through after the bull breakout. Traders will sell just below the low of that bar, and they'll get filled on this bar. Is this really a failed breakout below the bottom of the wedge? Well, I think it's more of a pullback than a failed breakout. We did not get above the top of the triangle or the top of the wedge. This is more likely a pullback from this 5 consecutive bear bar breakout. Wedges are very common and they're present on all charts, but they're rarely perfect. In fact, most of them don't look like wedges at all. Here we have a wedge bear flag. We can draw a line down here. We can draw a line here. You can say, well, wait a minute, Al, there are only 2 pushes, 1, 2. But yes, however, there's a double bottom. We tried to go up here. We tried to go up again. We have 2 reversals up, 1 and then 2. That means 2 pushes down, 1, and then this little bear bar, 2. And this is a 3rd push down. When you have a double bottom and a breakout below it, that is a type of a wedge. Bear bar, bull bar, bear bar, bull bar, and 3rd push down here, a wedge bull flag, a wedge pullback after a strong bull breakout. If you want, you can call it a triangle and say the first push down was here, which means this strong bull bar, in fact, was part of the pullback from this initial breakout. As strong as this is, some computers see this bull bar as part of the triangle, the pullback from this initial breakout. 3 pushes down, bear breakout, first push, and then a second push, and a third push. Not really converging lines, but still I think of it as a wedge bottom, and I look for a bull breakout. Wedge top, you can say, well, what are you talking about wedge top? You got 1 push, maybe first push here, and then are you calling this a second push and this a third push? Yes, this is a breakout, and therefore it's a push. And then we have a second push here and a tail, third push here. This is a small wedge nested within a larger wedge. This is the first push. Other computers will say that's the first push. In any case, it's a bull channel with slightly convergent lines. I think of it as a small wedge top. And on a smaller time frame chart, it might be a very good looking wedge top. We broke below the bull channel, might get a second leg down. And we rallied up with 3 or 4 pushes, 1, 2, 3, and 4. This is a wedge bear flag. We got a small second leg down. Leg 1, pull back, leg 2. Very tight bull channel, not convergent lines, but a series of biclimaxes, 1, and then 2, and then pull back, and 3. On a smaller time frame chart, this is probably a wedge. You could say this is the first push, second push, third push, doesn't matter. You have 2 or 3 pushes in a fairly tight channel. I normally would not call that a wedge. However, you can think of it as a wedge, at least an inferred wedge on a smaller time frame chart. You expect a bear breakout. You don't necessarily expect a big bear swing like that, but sometimes you get it. Maybe this is the first push, second push, maybe first push, second push here, and then third push there. Different computers look at it differently. In this video, I talked about what I mean when I use the term wedge. Basically, I mean any pattern that has 3 pushes. It's more reliable if the 3 pushes are in a channel that is converging. However, any 3-push pattern is a variation of a wedge. I'm Al Brooks. Thank you for watching the Brooks Trading course. This is the first of 5 videos on wedges. This is Al Brooks. Thank you for watching the Brooks Trading course. This is the second of 5 videos on wedges. I'm going to begin by making the point that wedges are rarely perfect. I'll then move on to talk about how most channels are wedges, whether or not the channels are convergent. And finally, I'll discuss the many different types of wedges. Sometimes a wedge has a leg that's only a single bar, and sometimes it's simply a doji bar. This leg, 2 bars down, this leg, a couple bars down. Here, the third leg, maybe it's this bear bar, maybe it's these 2 bear bars with that low. 1 bar down, 1 bar down, 2 small dojis down. Here we have 4 legs, 1, 2, 3. Some computers will say this is 1, 2, 3. These are small patterns, and they're probably clearer on smaller time frame charts. However, I would not go looking at the smaller time frame charts. You can infer what's going on simply by what you see on this chart. Different computers use different bars to count the legs. Doesn't matter. Is this the first push-up or is this the first push-up? Doesn't matter. Both computers, no matter how you do the count, see the same thing. They see a bull channel, maybe convergent lines. They expect a bear break below the bull channel. Again, very tight channel. Does not look like a wedge here. However, you can infer that it's a wedge on a smaller time frame chart. 3 pushes down here, and it's not really convergent. However, 3 pushes down, context is good for a wedge. We have a spike, pullback, and then possibly a channel. Strong enough breakout here for at least 1 more leg down. So 1, 2, 3, traders will look for a reversal up. The closer something is to the ideal, the higher the probability that it will behave like the ideal. So the better looking a wedge, the more likely a lot of computers and traders will trade it like a wedge, and therefore more likely you'll get the reversal. Wedge bull flags, we have a bull trend, and a wedge bull flag here, wedge bull flag here. In these bull flags, we have a couple bear bars here, 1 bear bar here, a couple bear bars here, here 1 bear bar, another bear bar. And the bear bars are attempts to create a bear breakout. For the bulls, the bull bar that follows that bear bar is a pullback from that bear breakout. So we have a bear reversal or bear breakout, and then a pullback. Another bear breakout, another pullback. Another bear breakout, and another pullback. At some point, the bears decide that all of these strong bear breakouts are not working, and they stop selling, and the market then ends up going the other way. All of these reversal attempts are minor, and therefore part of a trading range or a bull flag. Wedge bear flag. The bull legs are sometimes small, 1, 2, 3 bull bars, and they're attempts to reverse the bear trend. Here, we tried to reverse up, failed. Tried to reverse up, failed. Tried to reverse up, tried to reverse up, and failed. Traders see this as a bull breakout and then pull back from that bull breakout. Another bull breakout, pull back from that breakout. If the bull breakouts repeatedly fail, the bulls eventually give up and the market goes the other way. Reversals in trading ranges are common, and a lot of the patterns are wedges. We have a bull breakout here, and then we have a small bear trend that's not falling very far, but this bear trend, this bear channel, I would call it a wedge bull flag, and we got a bull breakout. The pullback ended, or the pullback was a wedge bull flag. And that's true here as well. We're trying to trend down. We have a lower high, we have a lower low. It's a bear channel, but it has a wedge shape. And here, it's only about a 50% pullback in a bull trend. The odds are this wedge bear channel is going to have a bull breakout, and therefore, it's a pullback in a bull trend. Here, we have a sell-off and a pullback. And this pullback has a wedge shape. It's a small bull trend. We have higher highs and higher lows, but the odds are you're going to get the bear breakout, so you can call it a wedge bear flag. Here as well, even though it doesn't really have a wedge shape, if you want, you can call it a wedge bear flag. A bull trend, but a minor reversal, and a bigger bear trend, maybe about a 50% pullback. This is really not a good example of it, but the idea is that you have a bear trend, about a 50% pullback, and you can infer that it's a wedge on a smaller time frame chart. So it's a wedge bear flag. The same is true here. This has a little bit better wedge shape, but it's a wedge top. Wedge bottom. I like to connect the first point with the third point. That means the second push is often below the line. Here's the start of the wedge, possibly the end of the wedge, and I ignore that second point going below the line. And that's true of a lot of wedges, that if you connect the first and third points, the second point is often beyond the line, and that's okay. Different ways to draw this, 1 or 1, and then 2, 3. I talked about this earlier, that we have a bull breakout here and then bad follow through, a pullback. And that this resumption up, some computers see it as part of the pullback. Even though it's a new high in the bull trend, it could be part of the pullback that began with this bar. Some computers see this whole thing as a triangle, which means this big bull bar, in the minds of some computers, is part of the pullback from this initial breakout. Most wedges are not perfect. Any 3-push pattern qualifies, and therefore most channels are wedges. By the time you decide that you have a channel in front of you, you have 3 pushes, and therefore it's a type of wedge. And again, the closer it is to ideal, the higher the probability that you'll get a profitable reversal trade. 3 pushes up, again, I connect point 1 with point 3. If I use point 1 and point 2, point 3 will not reach the line. And I like the reversal to be taking place at a line. So if I see this bull bar and then a bear bar here, I think of it as a wedge. I draw a line, 1, 2, 3, and I ignore bar 2 going above the top of the line, overshooting the line. Most spike and channel trends end with wedges. Strong bear breakout, so you think of it as a spike and a first push and a potential wedge. 1, 2, 3. Nested patterns are common. We have a big spike down here. We have a smaller spike down here. I mentioned that I think of wedges and channels as synonymous, and if they're convergent, I call them wedges. If they're more parallel, I simply call them channels. Reversal up with a decent buy signal bar. Whenever I see two reversals, I start drawing lines. I connect the lows and extend the line and see what happens. If we reverse up here and come back down here again, I would have a potential wedge bottom. I want to see what happens if we come back down toward that line. Do we reverse up? We went sideways and we had another bear breakout, but look what happened when we got right next to the line. We have a doji bar and then we have a micro double bottom. I think of this as a wedge, even though the shape of it is not all that good. The third push down did not quite reach the line, and therefore you have to be wondering, are we going to go a little bit lower? This is an undershoot. Undershoot means the push did not quite reach the line. Because traders are wondering if it's going to continue down a little bit further, buying above this bar, low probability. Higher probability to take a second entry buy. Here we have a micro double bottom and a second entry buy with a decent buy signal bar. And the result, we got a very strong bull breakout and at least a small second leg up. Again, as soon as I see two reversals, I draw lines. Reverse down, try to reverse down, I draw a line. And then I see what happens when the market gets back to that line, if it gets back to that line. And here we touch the line, went a little bit above it, and we have a bear bar. So this is a potential wedge top. Probably a minor reversal after such a strong breakout. Minor reversal means trading range more likely than bear trend. Small overshoot, that's a buy climax. We get the reversal. If you get the bull breakout and a reversal down, you have an increased chance of a swing down, especially with a pretty good sell signal bar here and a decent entry bar here. The bars are pretty small here, so this looks like it's not going to go all that far or all that fast. Usually, if I start to see this, if I short that and then the market does this, I just get out. Reasonable to short below the wedge, spike pullback channel, expecting a test of the bottom of the channel, but it took a lot of bars to get there. And as I said, I typically get out when the market starts to do that very tight range. Just because I see it as a wedge does not mean that all the computers see it as a wedge. Also, different computers will use different reversals to create the wedge. A bull breakout and 3 pushes up, so a small wedge top. Other computers will say, well, maybe the wedge top is 1, 2, 3, and we did not quite reach the third touch of the line. Maybe you want to call it an expanding triangle top. I don't know, but some computers will see the 3 pushes as 1, 2, 3. Other computers will say 1, 2, 3, and not call it a wedge, simply call it a bull channel. And then look for a reversal down, especially a second reversal down. First attempt, and then second attempt. The market tried 3 or 4 times to break to a new high, and it's failing. Instead of finding buyers eager to buy the bull breakout, it's finding sellers. Every time it goes above something, it's reversing. Above here, reversing. Above here, reversing. Above here, reversing. The bulls and bears are agreeing that the price is too high. It doesn't matter if you call it a wedge, an expanding triangle, or channel. The market continues to reverse after every attempt to break to the upside. Usually then the market tries to go the other way. It'll conclude it has gone too far up. Again, you can call it a wedge with a bad shape. You can call it an expanding triangle, a failed breakout above a wedge top, wedge 1, 2, 3. It doesn't matter. The market's repeatedly trying to go up and failing. You have to be thinking it may try to go the opposite direction, so traders will be looking to sell a reversal down, either below that reversal bar, bull body, or higher probability below this bear bar closing near its low. As As I said, there are many ways to draw the lines, and different computers use different algorithms, and they draw the lines differently. 3 pushes down, 1, 2, 3. Other computers will say the first push was here, 1, 2, 3. This push down from here was followed by a new high. You have a bear channel, but markets often transition, and there's often a time when it's both in a bull trend and in a bear trend. And that's why you can get a bear trend beginning before the bull trend ends, because you get the transition phase when the market is in both. You could draw the line 1, 2, 3 and call this an undershoot, did not quite reach the line. As I said, if I see a reversal up from a third push down, I usually connect the first point and the third point when I'm in my chat room to illustrate the wedge. Repeated reversals on sell-offs. Traders will look to buy a reversal from a third push down. Here, different ways to draw the 3 legs down. Three pushes down, 1, 2, 3. Not a very good looking buy signal bar, plus it's following 2 bear bars. Usually higher probability to wait for a second entry, which we got above this bar. A bull breakout, bad follow through, first push down, second push down, third push down. An undershoot, did not reach the line. And after this initial reversal attempt, we went to a new high. This bull bar, you can call it part of the bull trend, or you can call it part of the pullback from this initial breakout. Again, bull trends, when they transition into bear trends, usually have a period of time when it's both in a bull trend and a bear trend. Wedge bull flag, bull breakout, traders will buy above a bull bar here, here, and here. This is not a bull bar, but it's a wedge bull flag. Other traders will buy above this bar, a bull bar closing on its high. This entire sell-off, approximately a 50% pullback from this breakout. You can call it a wedge bull flag, you can call it a higher low major trend reversal. Traders are going to look to buy reversals up. Wedge top, 1, 2, 3, with a bear II, an inside bar with a bear bar. Traders will take that short. Micro double top, up here and then down on that bar, and then up and then down on that bull bar. I'm now going to talk about different types of wedges. Take a look at this. We have clearly a bear breakout and a second leg down, but here we have a bear breakout as well, but it formed a higher low. This, in fact, is a type of a wedge pattern. There are 3 pushes down. Had this low gone below that low, you would call it a wedge. But what happened here is this is an undershoot. The third push down did not fall below the second push down. In fact, it did not get anywhere near the trend line at the bottom of the wedge. However, the forces that form this pattern are the same as those for a wedge. When the bulls saw this reversal up, they knew there might be one more new low. However, they were so confident that there would be buyers below this low that many bulls started placing limit orders above this low, just in case the market did not fall there. And the result was we have a higher low and then a reversal up. However, it's a 3-push pattern, 1, 2, 3. If you want, you can call it a truncated wedge, but it is a wedge. And the bulls who bought here were buying because they assumed that if the market got below 2, there would be a lot of bulls buying there. And these bulls were just front-running the bulls who wanted to buy here. And the bulls who did want to buy the new low ended up having to chase the market higher. The bad shape, the lack of a wedge shape, the lack of a third push below the second does not matter. It's the same forces that create this as create a wedge. You can call it a higher low. It is a higher low, but it's really a variation of a wedge. The market tried to get a bear breakout 3 different times, here, and again here. and failed all 3 times, and then it decided to try in the opposite direction. That's exactly what happens in a wedge. The market makes 3 attempts down. However, typically the third push is below the second. All 3 fail. The market then decides it cannot go lower, so maybe it's gone too low already, and then it tries to probe in the opposite direction. When the bulls and bears are both confident that a third push down to a new low will create a wedge reversal, many bulls buy early, and a lot of the bears take profits early. The bears are selling reversals up, betting that they'll fail. They'll sell here. However, if they're deciding that this is too strong a buy setup, a very good bull bar here, chances are there'll be buyers below. A lot of the bears will take profits early because they do not want to take a chance that the market might form a higher low. So the bears are starting to scalp out early, and the bulls are becoming very confident. A pretty good reversal here, very good bull bar here. Really not a lot of strong selling. There's some, but look at all the bars to the left. This is a sell-off, but very weak. Traders, both bulls and bears, are now confident that there's not much left to this bear trend. And the result was a higher low instead of a lower low. But it's still a variation of a wedge. Too many traders trying to buy around that second low. Bulls trying to buy for a swing up, and bears trying to buy back their shorts. Take a look at this. We have a double top. We have a head and shoulders bottom, left shoulder, head, right shoulder, or a double bottom, right shoulder, and we're getting a bull breakout above the neckline of the head and shoulders bottom, and a breakout above the double top. But think about what's going on. The bulls are trying to rally. They fail. They're trying to rally again, and they fail. And they're trying to rally a third time, and look what's happening. They're failing. This is a 3-push pattern. Anytime you have a double top and then a bull breakout, you have 3 pushes up. If that third push fails and the market reverses down, this is a variation of a wedge, and the computers will treat it like a wedge. 3 strong pushes up, each one reversing. They'll bet that the market has decided it cannot go up. Maybe it has gone up too far. Maybe it now needs to go down and find what price is too low. Bears, they see a double top bear flag. They'll sell the reversal down. And a lot of them will put their stop just above the double top, and they'll get out here as the market is going above the double top. The bears will buy back their shorts, and the bulls will buy as well. The bulls see it as a bull breakout above a double top, and they expect a measured move up. However, the market then reversed down, a big tail, and now a bear bar. Traders will start to sell. Bulls will sell out of their longs if they have not already taken profits, and bears will start to sell either here, or they'll wait until after they see many consecutive bear bars, and now we have a low 2 bear flag. Low 1 below this bar, low 2 below that bar, and they'll sell here. Higher probability selling after you see 3, 4, or 5 bear bars after the reversal down, but both shorts are reasonable here, or selling closes on the way down here. Three pushes up or down, that's not enough. They have to be strong compared to the other bars and the other legs. Context, the bars to the left have to make sense for a reversal. Otherwise, the market is only going to go sideways. Here we have a wedge, 3 pushes up, 1, 2, 3, but there's nothing to reverse. The market is really not going up all that much. It's simply part of a trading range, and therefore the reversal down is probably going to lead to more trading range. Leg 1 up, reversal down, not all that strong up. Leg 3 up, not all that strong up. Most computers will not consider this a wedge. There were not 3 strong pushes up. There was 1 strong push up here, but not 3 strong pushes up. Traders will see this more as legs within a trading range, and they'll expect more trading range, not 3 strong attempts to rally that are failing. Here we have 3 pushes down, 1, 2, and 3, or 3, or 3. However, it's in a tight trading range. There's really nothing to reverse. The market might go up, but more likely the tight trading range will continue. Markets have inertia, and they tend to continue what they've been doing. And if it's been in a tight range for 15 or 20 bars, it's more likely to continue in a tight range than it is to get a bull breakout and a resumption of this small bull trend. If a pattern does not look right, computers will ignore it, and you should ignore it as well. In general, traders will call it something else. For example, if the reversals are all around the same price, traders will call it a triple top or a triple bottom instead of a wedge. If the context is good and if the legs are strong, it's still tradable. Three pushes up, maybe it's a wedge top. This is actually what I would call a small breakout of a small breakout. Here's a small breakout of this. This is a small breakout of that. It's mostly horizontal, and we have an attempt at a reversal down. There's a higher probability of a measured move up when you break above that. In general, if you break above any kind of a wedge, 50-50 chance you get a swing up, 50-50 chance you get a reversal down. But when the pattern is more horizontal, like a trading range, and you get a small breakout of a small breakout, it's closer to 60% chance of a measured move up, a swing up. Pretty good bull bars here and again here. Increasing buying pressure in a trading range. The odds are we're going to get a bull breakout and a swing up. You can also call this a head and shoulders bottom if you want. Left shoulder, a lower low head, and then a right shoulder. You can call it a double bottom pullback, a double bottom, and then a pullback, which is a type of triangle, even though this low is below that low. Many different terms for the same pattern. For me, it's mostly a small breakout of a small breakout, where all three legs have good buying pressure, and there's an attempt at a reversal down after the third breakout attempt. The market's also in a broad channel. We're getting higher lows and higher highs, and there was room to the top of that channel. If you have legs within a tight trading range that are strong enough, you can get a minor reversal, for a scalp in other words, but rarely will you get a swing trade. Three pushes up, 1, 2, 3. Selling below this, we have a bear II, a bear inside bar, inside of another inside bar. The sell here is probably going to result in simply another leg in the trading range, and therefore a scalp and not a swing trade. Three pushes down, 1, 2, 3, not all that strong. A second entry buy probably would be a scalp. Here, the bull's got a break to the top of the range, and then terrible follow through. Same thing here, three pushes down, not very strong, basically in a tight trading range. If you're taking this buy, you're probably looking for a scalp up to the top of the range. None of these has a wedge shape, but they all function as a wedge. The market made three strong attempts to go one way, and the breakout failed. The market gave up and tried the other direction. The same forces as in a wedge, but here the patterns are small and sideways. They're minor reversals leading to scalps. Usually when I see patterns like that really don't look like wedges and the context is really not good for much of a breakout, I do not use the term wedge. I use other terms like a triangle or a triple top or a triple bottom, or simply call it a tight trading range. Instead of worrying about a wedge here, I would simply call it a tight trading range. I mentioned earlier a breakout above a double top that fails is a wedge top. If you have a double bottom and a bear breakout and it reverses up, you have three pushes down. Computers will treat it like a wedge. Here we have an attempt at a double bottom, and we have a bear breakout. Three pushes down, 1, 2, 3. To me, it's functionally the same as a wedge. I could have drawn a line across here. You can call it a triangle, you can call it a wedge, but It's the same forces that a wedge has, 3 pushes down. So if you get a breakout below a double bottom and it reverses up, its function's the same as a wedge, and you look for a reversal up. Here, in a tight trading range, you're not looking for much of a reversal. It turns out we got a pullback and then a second leg up. But in general, a breakout below a double bottom that reverses up is a type of a wedge because it's 3 pushes down and all 3 reversed up. The same here. We have a double bottom, and then we have a bear breakout, and it reversed up, and it reversed up a second time. I would not call it a wedge. I would call it a double bottom with a failed breakout. However, it is a type of wedge. 3 pushes down, all 3 reversing. Double bottoms, bear breakout, reversed up. They function as wedges. Here, double top. And a bull breakout that reversed down is 3 pushes up, 1, 2, 3, and all 3 are reversing. The market's deciding that up is not the right direction. It has to probe lower. It's a type of wedge. However, I usually refer to this as a failed breakout above double top. Same thing here. We have a double top and a breakout. 3 pushes up, 1, 2, 3, and then it reversed down. You can call it a wedge. It's a type of wedge. It's the same forces as a wedge. A lot of traders would simply call it a triple top or a failed breakout above a double top, or they would look at this and call it a tight trading range and a failed breakout above the top of a tight trading range. Big bear breakout closing below the low of the wedge, closing below the low of the past 30 or 40 bars, probably going lower. Traders will sell the reversal down, or after this breakout, this is a bear flag, they'll sell below the low of this bar, betting that the bear trend will resume down. It's higher probability to sell after you see a strong bear breakout. I made the point in this video that wedges are rarely perfect. Also, most channels, whether or not they're convergent, are variations of wedges. And then I talked about some variations of wedges, like failed breakouts above double tops and failed breakouts below double bottoms. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on wedges. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on wedges. I want to begin by making the point that a bad wedge is not a reversal setup. It's not going to lead to a reversal. Next, very often when you have a wedge, the reversal trend, the opposite trend, begins before the old trend ends. If you go from a bull trend to a bear trend, or a bear trend to a bull trend, there's usually a transition during which time both trends are in existence. Finally, you can often enter earlier on a smaller time frame chart, although most traders should stay with just one chart and not look at other charts. The market's breaking to the downside, and again here and again here. And you can count 3 pushes down, 1, 2, 3, and therefore a wedge. But a wedge alone is not a reason to buy in a strong bear trend. This bear channel is very tight. If you get a reversal, it's probably going to be minor. Bear trends are always forming wedge bottoms. 1, 2, 3, 1, 2, 3, 1, 2, 3. And just because you can count 3 legs does not mean it's reasonable to expect a reversal. A tight bear channel like this is a breakout on a higher time frame chart. When the market's in a breakout, a bear breakout, you should only look to sell and do not look to buy. Any reversal like this or like that, it's profit taking by the bears who will be looking to sell again soon. It's not a realistic attempt at a bull trend. The reversals become bear flags not bull trends. And look at this. We have a leg down and we have a reversal attempt, but the high did not go above the low of the breakout point. There's a gap. We have another bear breakout, another reversal attempt. Good looking bull bar, but it did not close the gap. This bear trend is forming gaps. When the legs do not overlap, when you're forming gaps like that, the bear trend is too strong to buy. Also, where are all the bull trend bars? Where is evidence that the bulls are strong? You have one bull trend bar here, but look at the follow through. And finally, the lines are not convergent. There's not a wedge shape. The stronger a bear trend is, the stronger the buy signal bar has to be to overcome the strength of the bear trend. And here, there are no really strong bull trend bars. There's a bull reversal bar here, a small one here. Does this small doji look big enough to reverse that bear trend? No. And the same with this. We have a good entry bar, but where is the follow through? We have a bull breakout and a very tight channel. And on a higher time frame chart, this is also part of the breakout. This breakout would be continuing up on a higher time frame chart. And when the market's in a tight channel like this or in any kind of a breakout, only look to buy, do not look to sell. Bull trends are always forming wedges. 1, 2, 3, or 1, 2, 3, 1, 2, 3. You can count them any way you want, but all of those wedges are within tight bull channels, and therefore the reversals are minor, probably leading to a bull flag and a resumption of the bull trend, not a reversal. Remember my 80% rule. If you're in a strong bull trend, 80% of reversal attempts fail and become bull flags, and the bear scalpers keep losing money. They keep selling. They sell a failed breakout. They sell a final flag reversal. They sell a wedge top, another wedge top, another wedge top, another wedge top, and they keep losing money. In any trend, traders are always counting reversals. Reversal down, so the end of leg 1. Another reversal down, end of leg 2. And now we have a third leg and a pullback, end of leg 3. Whenever traders are counting bars or counting legs and they see a strong breakout like this, it's usually better to start the count over again. Instead of calling this bar 3, traders should call this bar 1. Whenever traders are counting legs and they see 3 pushes up, it's important to pay attention to symmetry. In general, you want the spacing to be about the same between point 1 and point 2 as it is between point 2 and point 3. If there's too big a difference between the spacing between point 1 and 2 and then point 2 and 3, computers tend to ignore this as a channel. Here there are 21 bars between 1 and 2, only 7 bars between 2 and 3. That is getting to be a little too asymmetrical, and traders tend to view this less as a wedge and more as a bull channel with more to go. This strong leg up, a lot of traders would restart the count and say this is point 1, this is point 2. Strong bull breakout, start the count over. This then is point 1, point 2, point 3. We have 3 pushes down, 1, 2, 3, convergent lines, and a gap, this high and the breakout point. That is a problem. Whenever there's a gap, even though this bar pulled back above the low of this bar, this is the bottom of the first push down, and we did not go above that low. Whenever there's a gap in your wedge, the channel down is usually too tight to begin looking for a reversal. Wedges usually need stairs. They need overlapping with the pullback from the breakout going above the breakout point of the prior leg down. As a sign of buying pressure, you could also call it a wedge 1, 2, 3, but same problem, no overlap, and therefore it's probably not a reliable wedge bottom. 1, 2, 3, and then start the count over, strong breakout, 1, 2, 3, still forming gaps. That means the channel down is too tight, and the reversal probably will be minor. The limit order bulls buying below bars are losing money. If the limit order bulls are losing money, the stop order bulls buying above bars probably will lose money as well. Therefore, the bulls are too weak to be looking for them to create a reversal up other than a minor reversal. The channel is very tight, it's not broad, no consecutive big bull trend bars, not enough buying pressure for a reversal, and therefore a reversal up is probably going to lead to either a bear flag and another leg down or a trading range. And here it did both, tight trading range and a new low. Sometimes the legs in a wedge are subtle, and sometimes it's only a bull bar followed by a bear bar. This is a nested wedge. We have 1, and then a reversal down 2, and a reversal down 3, but the third leg subdivided into a smaller wedge, a bull bar and then a doji, a bull bar and then a bear bar, a pair of bull bars and then a bear bar. On a smaller time frame chart, it would be a wedge. On this chart, it's inferred. Whenever you see a bull bar and then a bear bar or a doji bar, that is a first leg. Another bull bar and then a bear bar, that is a second leg. Very tight bull channel here, and the entire channel is tight. And therefore, the first reversal down probably is going to be minor, leading either to a bull flag or a trading range. Here we got a 15-bar tight trading range, TTR, tight trading range. Within it, there's a small wedge, 3 pushes up, bull, bear, bull, doji, and then a third push. You often get a lower high major trend reversal when there's a tight trading range after a bull trend. It usually comes as some kind of a double top. You could say this bar is a double top with that bar. The probability, like most major trend reversals, is low, maybe a 40% chance you get a swing down. But if you wait for the breakout and then sell, the probability of lower prices and making money is higher. Selling late, the stop is further away, so the risk is greater. Selling early, the stop is close, the risk is less, but the probability is less as well. Both are acceptable. Here we have a wedge bottom, 1, 2, 3, and the minimum that traders need to see to conclude it's a wedge is a bear bar followed by a bull bar. So 1, pull back, and then 2, pull back, and then 3. However, there's a smaller wedge as well, a bear bar, doji and bull bar, and then bear bar, bull bar. This is also a smaller wedge, 1, 2, 3. So different ways to draw it. 1, 2, 3. And the bulls got a higher low major trend reversal. They have a bear trend, possible final flag, lower low major trend reversal. Not much of a strong breakout, but we had several strong legs up. Traders will look for the bear breakout below this trading range to fail. This trading range then will probably be the final bear flag. You can call this a final flag reversal or a lower low major trend reversal. You could say bear trend, bull breakout by going sideways, and then resumption of the bear trend that failed. Good reversal up, and then a spike and channel down, spike, first push, second push, third push, with a good buy signal bar. I think it's important to realize that most reversals begin before the prior trend ends. There's a transition. Here we got a bull trend and a wedge bull flag. 3 pushes down, 1, 2, 3. But look at this push down. This bear channel, a small bear trend, began before the bull trend ended. And the same here. We have a push down, a new high, and then a second and third push down. You can call this a triangle or a wedge. This is the first leg down of this wedge channel, this triangle. Yet it occurred before the bull trend ended. The same here. This wedge bear flag, bear channel, began before the bull trend ended. And that makes sense. Usually a bull trend does not go into a bear trend. There's usually some kind of a transition. And the transition often is the first leg of the bear trend begins before the bull trend ends. The same here. First leg down in what became a wedge bull flag came before the bull trend ended, and the same here. You could say that the bull flag began here, 1, pullback 2. I think it's more realistic to say this was the start of the bear trend, and there was a transition in here where the bear trend was beginning and the bull trend had not yet ended. The same with here. You could say it's a high 2 buy, leg 1, pullback, leg 2. I think it's probably more of a wedge bull flag, and the bear trend and bull trend coexisted. There was a transition. The bear trend began before the bull trend ended, and the bull trend was still in effect, even though the wedge bear channel had already started. This is how I would label it, 1, 2, 3, and the same here. I think this is part of the correction, even though the bull trend has not yet ended. In any case, whether you call it a high 2, 1, 2, or a wedge, 1, 2, 3, you're going to buy the reversal up, and the same with this as well. Legs can be small, sometimes as small as a single bar. You can look at a smaller time frame chart, but it's usually not worth doing. You can just infer what's going on by the appearance of what's going on the 5-minute chart. Here, we have a leg that is only a single bear bar, and it's followed by a bull bar. So to me, that's a leg down, and it ended with this bull bar. Here, we have a few bars down and ended with a bull bar. Here, a few bars down, ended with a bull bar. Here, we have a tail. The market traded down and traded up. On a smaller time frame chart, that is a small leg 1. We have a bear bar followed by a bull bar. This is a leg 2. We have a bear bar followed by a bull bar. That means it's a third reversal up. This is a small wedge bull flag. On a smaller time frame chart, you'd see it, but you can infer it simply by looking at this, and this is all that you need to see. The same here. A doji bar went down and up, we went down and up, and then we clearly went down and up. This is a type of a wedge pullback, even though it does not have a wedge shape. And the same here. We have a bull breakout and then a bear inside bar. That could be the first push of a wedge bull flag. In fact, that's how I would label this. You could call it simply a high 2, leg 1, pullback, leg 2. I would call it a wedge bull flag, 1, 2, 3. Where the market transitioned. Here, it was still in a bull trend, and it was in the start of a bear trend. The important thing is to realize it's a bull flag, so you want to buy the reversal up. Whether you call it a high 2 or a wedge, you want to buy the reversal up in every instance. A wedge bear flag, it's a small bull trend, and it can begin while the bear is still underway. This is usually a transition. The first push up can be a lower high in the bear trend, followed by a new low, but still part of the bull channel, the bear flag. For example, here, strong reversal up, yet the bear trend continued. A second push up here, third push up here. You can call this a wedge bear flag, even though the bear flag began before the bear trend ended. The same with here. A transition, we're in a bear trend, yet we're starting to have a bull trend before the bear trend ended. There's usually overlap between the bear trend and the bull trend. There's a time when both are in effect. Here, I think this is the start of the bull trend. a bull trend bear flag. Every bear flag is a small bull trend, yet the bear trend still is working lower. You can call this 2 legs up, 1, 2, or you can say maybe it's a wedge bear flag where the bull trend began here, and then 2, and then 3. That's how I would label this. I would label this a wedge. I don't have the line drawn in here, but if you did draw it in, this would become a wedge-shaped pattern. Again, the rally, a wedge rally, it's a small bull trend, I think began here while the bear trend was still in effect. This is a transition from bear to bull, and there's a period when both are still operating. The bull trend is beginning, the bear trend is still continuing, and this bear leg is part of the bull channel. The same here. As you can see, it's pretty common. Reversal up, the bear trend is continuing, but this reversal up is the first push up in a wedge rally. The key point, you're in a bear trend, you're looking to sell a reversal down from every rally, betting that the rallies are minor and therefore bear flags and that the bear trend will resume. So you sell below the low of that third push up. You can enter earlier on the smaller time frame chart. I think traders will make more money if they just trade the chart that's in front of them and not look at other charts. This is the euro versus the yen, a monthly chart, clearly a wedge bottom, 1, 2, 3, or 3. And then a good IOI buy setup here. Some traders will anticipate this, the reversal. They'll see the wedge, and they'll start looking at a weekly chart or a daily chart, or even a 60-minute chart or a 5-minute chart for a reversal that could lead to a swing trade up. A lot of times the first attempt will fail. Here we have a lower low. We have a wedge, 1, 2, 3, nested maybe, 1 or 1, and then 2 and 3. A reasonable buy, fairly tight channel, weak buy signal bar. This reversal probably is not going to be successful. But this one, we have a bear breakout, a good reversal bar, another bear breakout, another good reversal bar, has a higher probability of success. If you're trading the monthly chart, you buy above the high of this bull bar, and here's your fill price, 99.18. Again, you could draw the wedge 1, 2, 3, or 1, 2, and then 3. Some computers do it one way, others will do it the other way. This is a daily chart of that same reversal. If you were buying on the monthly chart, this is where you would be buying, 99.18. On the other hand, if you looked at that monthly chart and you saw the wedge starting to form, you could look at a daily chart and try to enter earlier, like for example here, 95.21, or here, 96.91. This is the euro versus the dollar on a 60-minute chart. And you can see maybe we're forming a wedge. 3 pushes 1, 2, and it's starting to push up here, 3. You got a wedge bull flag, 3 pushes down, 1, 2, 3. If you're anticipating a continuation of the bull trend, then you might start looking for bull flags. And if you see a first push and a second push down, this is strong enough so that we probably are going to get one more push down here. You can take the trade on the 60-minute chart, buying above the high of this bar, or you can look at a smaller time frame chart for an earlier reversal. If you buy the wedge bull flag here, your entry is here, 1.0795. And this is the 5-minute chart. This would be the 60-minute entry right there, 1.0795. However, on the 60-minute chart, you saw the possibility of a wedge bull flag. You could look at a 5-minute chart for an earlier entry, for example, here or here, a micro double bottom or a triangle, 1, 2, 3. The entry price is 1.0780, about 15 pips lower than the entry on the 60-minute chart. I began by talking about how bad wedges are not reversal setups. Bear trends are always forming wedge bottoms that are bad and the market keeps going lower. Bull trends are always forming wedges that are bad and the market keeps going higher. A bad wedge is one where the legs do not overlap. It's not a stairs pattern. There are open gaps, or the channel is too tight to expect a major reversal. I then moved on to talk about how new trends begin often before the old trend ends. There's usually a transition from one trend to the other. And finally, I talked about how traders sometimes like to enter early. If traders are trading a very high time frame chart, a monthly chart, weekly chart, 60-minute chart, they will often look at a smaller time frame chart for an earlier entry. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on wedges. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 5 videos on wedges. I want to start by talking about parabolic wedges. A parabolic curve is one that increases in its slope as it progresses. It's a type of a biclimax if it's a bull wedge. It's a type of a sell climax if it's a bear wedge. Also, strong trends always have bad-looking wedge reversal patterns. When I talk about a parabolic wedge, the wedge often does not have much of a wedge shape, but it does have 3 pushes. It's 3 consecutive biclimaxes. Here is the first push. You can say it's this 1 bar or these 3 bars, and then this second bar, and then that third bar. First push up, second push, third push. 3 pushes, so it's a wedge. Very tight channel. When it's a tight channel like that, I usually refer to it as a parabolic wedge. If it occurs at the start of a session, it's more likely to lead to a reversal. The third push here subdivided. We had a first push and then a pullback, and then a second push and then a pullback, and then a third small push, and then a reversal down. You can call it a nested parabolic wedge. You can see the tail on the top of this bar, on the top of this bar, on the top of this bar, and here as well. Every time the market's going up, instead of finding new buyers, it's finding sellers. There are often gaps. The legs don't overlap. Second push up, the pullback from the second leg did not overlap the top of the first leg. There's a gap. The channel is very tight. I'm drawing an approximate channel here, but it's a very tight channel. On the way down, the same thing. A first push down, a pause, a second push down, a pause, and then a third push down, so 3 pushes down. I would call this a parabolic wedge bottom, and we got a reversal from it. The curve may or may not be parabolic. For example, this bull parabolic wedge is not parabolic. However, the bear parabolic wedge, if you draw a line connecting point 1 and point 2, and then another line connecting point 2 and point 3, the second line is steeper. So the downward slope is increasing, and that's why I use the term parabolic. You can see point 1, point 2 here, or point 2 here, and then the third push, it's steeper. Third push often breaks below the bottom of the channel before reversing. I could have drawn the line here connecting point 1, point 2, point 3, and the third breakout fell below the bottom of the channel and then reversed. That's another way to document how it's parabolic, how it's increasing its velocity downward. Anytime you have a parabolic wedge or parabolic series of biclimaxes here, 1, 2, 3, or sell climaxes, 1, 2, 3, you have to be thinking that the market has gone too far too fast. The stop is too far away. Traders have to take profits. Aggressive traders will sell a bull parabolic wedge or buy a reversal up from a bear parabolic wedge, betting on at least a small profit. Most traders should be very cautious and hesitant about taking these trades, and only take them if you can manage them well. For example, if you're selling below this bar or better below this bar, you want to make sure that you can rely on a stop up here, and you can sit through attempts at trend resumption here and here. If you take the first entry, entering here, your stop is up here, the risk is small, but so is the probability. If you wait until there's a strong breakout, a pair of consecutive bear bars, you have a higher probability of at least a small profit, but if you take this short, your stop is here or maybe even here, so you're risking more. And the same is true here. If you buy the first entry above this bar, your stop is right below, your probability is not all that high. If you wait until there's a breakout and follow through and then buy a close, the probability of making a profit is higher, but your stop is further away, either here, here, or here. And that's always the trade-off. If you wait and take the higher probability entry, you pay for it with worse risk-reward. The stop is further away, so you're risking more, and you're entering late, so there's less reward remaining in the trend. However, the math is good both for the early entry with lower probability, better risk-reward, and the later entry with greater risk, less reward, and higher probability of making profit. A parabolic wedge is a channel. We have a first push up, a deep pullback, a very strong second leg up to this high, and then a third push up there. If you want, you can call it a second leg trap in a possible trading range. First leg pullback, second leg, which it is, it's both. The second leg had 3 very big bull bars, and the tail on top represents the end of the second leg, and then we pulled back to the low of this bar and started the third leg. We have a pullback bar here, this tail plus the low of that bar, and it's the end of the second leg, and then we have the third leg up. You can take the short below that bull bar or below that bear bar, or wait until you see 3 or 4 consecutive bear bars, and then either sell the close of this bar or sell the close of that bar. At that point, the probability of making a profit is greater. If you take this later short, your stop is still up here, and you're expecting at least a small second leg down. This represents the market flipping to always in short. The bulls are giving up. They understand that this is a bull trap and that the market is probably going to trade down. In this particular case, we had a parabolic wedge top, and we have a first leg down, a pullback, a second leg down, and then a bull bar, a pause, and then a third leg down. A parabolic wedge bottom at the bottom of a trading range with a good-looking bull bar. You can see parabolic, if I connected the low of the first push and the second push, I get one line. And then if I connect the low of the second push and the third push, I have an even steeper line. And therefore, it's a parabolic curve accelerating downward. It's a failed breakout below the bottom of a buy climax, a bull leg. And it's also a failed breakout below the bottom of a bull trend. In this particular case, it formed a perfect double bottom with an earlier low, the bottom of the trading range. And you have a very strong buy signal bar. Even though the channel is very, very tight and you think the reversal up might be minor, this is a reasonably good probability trade for at least a couple legs up. 1 pullback, 2 or 2. We have a parabolic wedge here, a first push up, and then a tail. You can say we went up, down, end of the first leg. And then we have another pair of consecutive bull bars with a small tail on top, end of the second leg, and then a pullback to that close and that low, and then a third push up. For me, this is a parabolic spike and channel bull trend. It's a parabolic wedge. First push up is the spike, and then a pullback, and then a couple more pushes up. This bull bar, and then a small bull bar, pause, and then a bigger bull bar again. On a smaller time frame chart, you could see that this is a pullback here, and this as well, from that high to this low. But you don't have to look at the chart. You can infer it by simply looking at this chart. We have a pause and then a bull bar, two bull bars, a pause and then a bull bar closing near its high. 3 consecutive bear bars closing on their lows. The market probably is in the process of reversing from a parabolic buy climax. Look at bar 3 right here. Bulls are buying for any reason. They're buying closes. They're disappointed by this bear bar, and they decide maybe it's a parabolic wedge top. Maybe I should get out break even. They place limit orders to get out at break even at that close. And look what happened here. It got right to their entry at that close, and their limit orders did not get filled. The market turned down. The bulls started giving up, and then they continued to give up here. These 3 consecutive bear bars represent the bulls giving up. It's a give-up series of bars, and the bears are doing the opposite. They know this is a potential parabolic buy climax. They know the bulls are disappointed by this bear bar, and the bears start to short with a limit order just below that close, believing that the bulls will try to get out at that close. When the market gets near that close, the bears start to short with limit orders or at the market, and they turn the market down. After the second or third bear close, bears start selling closes. It becomes a sell the close bear trend, and the bulls are giving up. No one left to buy. We have a series of bear bars, a pause, a series of bear bars, and then a small bull doji, a pause, and then another sell climax here. You have 3 pushes down, 1, 2, 3. Parabolic wedge bottom, which is a sell climax, and it led simply to a trading range instead of a reversal. Very common when you have a sell climax or a buy climax for the market to go sideways instead of reversing. This is a very common pattern. Very strong breakout, second push, third push, or third push. We can call it a nested parabolic wedge, 1, 2, 3, and the third push divides into a wedge, 1, 2, 3. In any case, spike, pullback, parabolic channel, and then you get a pullback, 5 bars or 10 bars. It's still a bull flag at this point. 20 bars, probably still a bull flag. Maybe 25 bars, it still looks like a bull flag. The bulls are trying to buy, they're trying to buy again. But once you get this, a pair of consecutive bear bars closing on their lows, decent sized bodies, the bulls are giving up, the bears are taking control. It's probably going to be a measuring gap for a measured move down. You have a pullback that's endless. It just keeps going on for 10 bars, 20 bars, 30 bars. And that often is the start of a bear trend, especially after a parabolic buy climax. If you start to see it pulling back in a tight trading range that slopes slightly downward, after 5 or 10 bars, you have to be thinking that this could be an endless pullback that will convert into a bear trend. You can wait. There's no good buy. However, once you see the breakout, it's a good sell. Some bears will sell here, below that bar. Others will say, okay, you get disappointed bulls here. They'll probably try to get out break even if they bought that close. So there'll be some sellers at that close. You can see that tail on the top of this bull bar. And then another bar with a tail on top. It looks like the bulls are giving up. More bulls will sell below that bar, and bears will sell as well, taking a chance that the buy the close bulls are giving up, and they'll wait 5 or 10 bars to buy again. And it never got back to that price again. No consecutive big bear trend bars, but 13 bars in a bear microchannel. No pullbacks for 13 bars. Possible endless pullback. And when you see an endless pullback, there's a 50-50 chance you're going to get a bear breakout and a swing down. The bulls are trying to reverse, 2 legs down, 1, pullback, 2, but where is the follow-through buying? No follow-through buying. That means this might instead be a double top bear flag. A double top with this bull bar, slightly lower low. We have another tight trading range, and then we get the bear breakout. Bear breakout and follow-through, it's now always in short. All through here, it's always in long. The probability favors trend resumption up. But with each bar that gets added, it becomes more and more neutral. After about 20 bars, it's almost 50-50, maybe slightly higher probability for the bulls. But once you get the bear breakout and follow through, with a pair of decent-sized bear bars compared to the bars to the left, the market becomes always in short, and you're going to get probably a measured move down. From the top here, in the middle of the gap, I could have used the breakout point, which is this low or that low, and we got a measured move down. And what took place at the measured move down? Bears bought. They took partial profits here, very tight bear channel, even though good bull bar. A lot of the bears, if they do get out here, they'll sell again below a bear bar, like maybe below that doji bar for trend resumption down. This did not do enough to reverse it back to always in long. Here we got a gap up on the open, 3 pushes up, first push and then a pullback, second push and a pullback, and a third push. And now we have a bear body. Possibly a parabolic wedge reversal on the open. Is this particularly climactic? Well, not especially. We have 2 decent bull bars here and here. That means if it's not especially climactic, the bulls may not be exhausted, and instead of reversing into a bear trend, it might be simply a reversal and then a trading range, which is what we got. Without the climactic look to it, without extreme buying, consecutive big bull trend bars closing on their highs, this is more likely going to be a bull leg in a trading range rather than a climactic end of a rally and the start of a bear trend. The bears had a chance here, but you can see once the market got to the prior low, traders bought it. Trading range behavior, new low, reversal up. On the other hand, we have a pair of bear bars here, 2 big bear bars here, another big bear bar here. This is much more climactic than this was. Much more chance that this is going to lead to a reversal, especially with a pretty good looking bull bar. Yes, it's a sell vacuum test of the bottom of the trading range. We have a double bottom, a bear breakout, tried to reverse here, failed, tried to reverse again here. Good looking bull bar, and we got a successful reversal. Couple legs up, 1, pullback 2. This was simply a sell vacuum test of the bottom of a trading range, and we got a failed breakout below the range. I call this a double bottom, this low and that low, even though they're not at the same level. The market tried to reverse here. This is so strong, probably at least 1 more leg down. We got 1 more leg down. 2 attempts to reverse here and here, even though not at the same level. It's a type of double bottom. It's also a parabolic wedge. 1, pullback, and then second sell climax, pullback, and then a third final sell climax. Parabolic wedges are common on the open in the first hour or so. Anytime you see a strong rally with a pause and then a series of buy climaxes on the open, you always have to be thinking about the possibility of a parabolic wedge. Here, it's a possible parabolic wedge top. First push up, pause. Second push up, pause. Third push up, and then even a fourth push up. Is the parabolic wedge 1, 2, 3, or 1, 2, 3, 4? It doesn't matter. It's a series of buy climaxes on the open, and you have to be thinking about a possible parabolic wedge. And as often happens after a parabolic wedge, especially on the open, you get a pullback, and it forms a tight bear channel lasting about 10 bars, and then the market decides whether it's going to resume up or reverse down. Here, we get a big bear breakout, probably at least a measuring gap for at least a couple legs down. 1, pullback, 2. "13 bars up without a pullback." That alone, a 13-bar bull micro channel alone, is a type of a climax because it's unsustainable, and anything that's unsustainable is a climax. And then we have consecutive buy climaxes, a pair of bull bars, big bull bar closing on its high, a pair of bull bars, this one closing on its high, and then another attempt. Climactic behavior. You can call it a low 4 if you want. We tried to get a low 1, failed, tried to get a low 2, failed. And then we get a breakout, tried to get a low 1, failed, and then try to get a low 2. It's a type of low 4. We have consecutive tops. We tried to get a low 2 top here, instead got a breakout, and then tried to get another low 2 top here, and succeeded. Big bear bar, closing below the lows of the past 20 or 30 bars. far below those lows. The market's always in short for at least a small second leg down. The scale-in bulls who were buying all the way down gave up. They were overwhelmed, probably a measuring gap. The bulls tried to reverse here, but look at this high compared to that low. This is simply a breakout test of that low, and it failed, and we got a big second leg down. So leg one, pull back leg two. Parabolic wedges need extreme moves as a sign of exhaustion. Without the extreme moves, the traders do not get exhausted and the trend can go a long way. Here, 3 pushes down, 1, 2, 3, very tight channel. If you want, you can call it a parabolic wedge. I would not. Where is the extreme selling? We get a bear bar here, but it's small compared to these bars and these bars and this bar. This does not look climactic. It does not look like the bears are worn out. And the result was we have a wedge, but not climactic selling in a very tight bear channel. This is probably going to result in a minor reversal and a bear flag, and then continued lower prices. This is more likely a small pullback bear trend than a climactic wedge bottom. No big bear bars, no extreme selling, no climax. It's not yet overdone, and therefore the trend can go down much further. Again, the pattern is just too small to reverse a big bear trend like this, and the channel is too tight. Probably the best the bulls get is a bounce, and then the bears will get trend resumption down. No buying pressure. Where are the big bull bars in any of this? Minor reversal, do not buy. Do not buy a minor reversal in a tight bear channel. This is the dollar versus the yen, a 5-minute chart. We have a strong bull trend and a very abrupt reversal down. Big bear bar, a pair of bear bars, another big bear bar, 3 big pushes down, climactic, consecutive sell climaxes. You could even say sell climax, sell climax, sell climax, sell climax, sell climax. This is a parabolic wedge bottom, double bottom with this low, could be a spike pullback parabolic channel, and a double bottom with the bottom of the channel. You can also call it simply a parabolic wedge bull flag. It's a parabolic wedge bottom, but it's above the bottom of the bull trend. It's around a 50% pullback, and it's testing the bottom of a channel after a spike up, spike, pullback, parabolic channel. And then we reverse down, testing the bottom of that channel. A very good looking bull bar. It's a reasonable buy. You can see that you can draw a best fit channel, and this is within that channel. Strong bear bars, each one with bad follow-through. A series of sell climaxes, each one with bad follow-through. You have to be thinking that this is unsustainable behavior and probably a bear leg in a trading range or a bear leg and a bull flag, and the market will have at least a small reversal up. Bull bars after every big bear bar. That is not how bear trends look. That is how a bear channel that's about to have a bull breakout looks. Bear channel, bull flag, chances are you're going to get a bull breakout. Again, 50% pullback in a bull trend, probably a parabolic wedge bull flag. Trends always have wedge reversal patterns, and strong trends always have bad looking wedges. Lead to minor reversals, not trend reversals. Very strong bear trend, and if you look at it real time as the bars are unfolding, you'll constantly see wedge bottoms. But when a channel is this tight, a small pullback bear trend, each one of those wedge bottoms will lead to a minor reversal and a bear flag, and the bear trend will continue. There's just no significant buying pressure. A little bull bar here, a little bull bar there. Remember my 80% rule. 80% of reversal attempts in a strong trend will fail, and the trend will continue. 3 pushes down, 1, 2, 3, wedge bull flag. Very tight bear channel. Where are the bull bars? No buying pressure. This is not a tradable bottom. It's going to lead to a bear flag and a resumption of the bear trend. 3 more pushes. We have another wedge. We have tails. We have a bull bar. Is this a good buy? No, it's a very tight bear channel. Any reversal is probably minor. The best the bulls probably can hope for is a small trading range. More likely, there's going to be trend resumption down. We have a gap here, this low, that high. This might in fact be a measuring gap. In fact, it was. Another wedge bottom. Maybe we should buy. Maybe we should buy this. Very tight bear channel, minor reversal, probably bear flag. Another wedge bottom. Certainly this has to reverse at some point. Beginners are constantly seeing wedge bottoms and bear trends. This is a small pullback bear trend. The pullbacks only last a bar or 2 or 3 bars, and they don't go up very far. All of these pullbacks are bear flags. The trend will continue. Do not be too eager to see wedge bottoms in bear trends, especially a small pullback bear trend like this. All of these wedge bottoms will lead to bear flags and the trend will continue. Never look for a reversal when the channel is tight, because a tight channel is a breakout on a higher time frame chart. If this is a 5-minute chart and you look at a 15-minute chart, it'll be simply a series of big bear bars closing on their lows. And you do not want to be buying if every bar is a big bear bar closing on its low. Gaps all the way down, this high, that low. This breakout point, these highs, this low, this high. Gaps all the way down, very strong bear trend. Whenever you see gaps all the way down and the pullbacks lasting only a bar or 2, and not any consecutive big bull trend bars, don't even think about buying. Anytime you see a buy setup, wait for it to fail and reverse down and then look to sell. Expect trend resumption, expect every reversal to be a bear flag, and constantly look to sell. We're trying to reverse up, sell below a bear bar. Trying to hesitate, maybe base, sell below a bear bar. Sell below the prior bar, sell below the prior bar, sell below the prior bar. Again, 80% rule. If you're in a strong trend, 80% of reversal attempts will fail to reverse the market, and they'll become flags and the trend will continue. Wedge top, 1, 2, 3. But where is the selling pressure? Very strong bull breakout, a 1-bar pullback. A wedge top, but look at the pullback since this low. The pullbacks are just a bar or 2 and just really tiny. Chances are the best the bears get here is a trading range, not a bear trend. A low probability sell. Another wedge top. This time for sure it has to work. We have a bear bar here. The sell triggered. This went below that low. Another sell that triggered. A third sell that triggered. Certainly one of these reversals has to work. The pullbacks are way too small. Where are the big consecutive bear bars? Where is the evidence that the bears are strong? A sell signal bar alone, even if it's a third push up, is not enough reason to short a strong bear trend. Another wedge top and another sell. Look at all these great sell signal bars here, here, here. Now our fourth one. One of these has to work. Well, eventually one will work, but these are all low probability shorts. A bear signal bar alone is not enough reason to sell a wedge. There has to be some evidence of selling pressure, and when the pullbacks are really small like this and the channel is very tight like this, there's no significant selling pressure, so only look to buy. Every time the bear trend reverses, the bulls have to buy again. For example, above a bull bar. Bear trend reversing, buy above a bull bar. Bear trend reversing, buy above that doji or above this bar or even above this bull bar. Third push up, eventually it was successful, but it's still a low probability trade. Higher probability to wait until we get 3 or 4 consecutive bear bars and then sell. The sell signal bars alone are not reason enough to erase the bad context. It's a small pullback bull trend. Do not look to sell. Very tight channel. I don't have the bottom of the channel drawn, but you can see it's a very tight channel. It's a breakout. It's a bull breakout on a higher time frame chart. you only should be looking to buy. Until there's reasonably good selling pressure, bet that each reversal will become a bull flag, not a trend reversal, and buy above a bull bar after every reversal down. Now, I said most wedges in strong trends fail, and that is true. However, most strong trends end with at least some kind of a wedge. Wedge bottom, these are all meaningless. The bear channel is too tight to be looking for reversals. It's far too early to be trading this. It's a small pullback bear trend. It's a very tight channel. It's a bear breakout on higher time frames. Stop looking for reversals. Instead, look to sell a failed reversal, a bear flag. Whenever you see a bear trend that lacks consecutive big bear trend bars, this lacks consecutive big bear trend bars, yet it's forming gaps. Instead of looking at it as a possible bear leg in a trading range, you have to be thinking that it could be a small pullback bear trend, and it could last a long time. Do not look to buy reversals. Now we're starting to get stairs. We have a big bear breakout, and we broke below this low, but it pulled back above that low. The gaps are closing. We're starting to accumulate some bull bars here, 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 again here, and again here. There's some evidence of buying pressure. We have a wedge bottom, 1, 2, 3. I would consider buying this, betting that it's a spike in channel, bear trend, so spike, second push, third push, and that it will evolve into a trading range. However, it's higher probability to wait to buy a major trend reversal. Strong bull breakout, and the bulls are so strong they were able to create gap bars. 2 bars where the lows are completely above the moving average. There's a gap between the low of these bars and the moving average. That usually leads to the final leg of the bear trend before there's a major trend reversal attempt. Higher probability either to buy here for a scalp. This is probably a minor reversal because it's a tight channel. First reversal up probably will lead to trend resumption down. However, it's a strong enough breakout here, gap bars here. That strong trend resumption down will probably fail around the old low, and the bulls will try to get a major trend reversal. I would not buy above this bar after that big bear bar, but now we have a second entry buy. This is a higher probability buy. Higher low, major trend reversal, micro double bottom, this low and that low. It's a second entry buy, above here, above here. Higher probability to buy after you see a reasonably good breakout, and especially after you see 2 big bull bars closing on their highs. Probably going to get at least a small second leg up here or here. Bull breakout with follow through, a pair of consecutive bull bars. Resistance is always a magnet, just as support is a magnet. If you're reversing up, resistance is therefore a target. Whenever the market gets to some kind of a resistance level, there'll be some profit taking, which means there's often a pullback. If we're talking about resistance in a bull trend, bulls will take partial profits. The bears know that the bulls will take partial profits, and the bears will sell, at least for a scalp. Where's resistance? Well, first of all, the most recent lower high in the bear trend is resistance. And when the market got there, the bears tried to get a double top. The bulls took partial profits, 2 legs up, 1 pullback 2. Minimum goal for a wedge bottom is 10 bars, 2 legs up. We have first leg up, pullback, second leg up. A reasonable area to take profits around that prior high in case we get a double top, a break below the neckline, and fall for a measured move. We have a sell climax here, and tried to get a double top here. Instead, we broke to the upside, possibly a measured move up based upon the height of this double top attempt, and you can see additional profit taking there. You could also draw a measured move up from this low to that high, a measured move up from the bottom of the trading range to the top of the trading range. All of those are possible resistance areas. We have another lower high in the bear trend. It's a major lower high. It led to a new low and a strong bear breakout. So there'll be some profit takers around there as well. wedge bottom, it's a bear channel. And a bear channel is a bull flag. 75% chance you'll get a bull breakout. Only a 25% chance you'll get a bear breakout and then a swing down for a measured move. A bull breakout does not mean bull trend. It simply means a break above the top of the channel. It could result in a trading range, as it did. But once it enters a trading range, then traders will look for a major trend reversal, which we got. A wedge top, it's a bull channel. A bull channel, a bear flag. 75% chance you'll get a bear breakout, at least into a trading range, possibly into a bear trend. This wedge top is at the prior high, so it could be a consecutive series of buy climaxes testing the top of what could become a trading range. Bull channel, bear flag, only 25% chance of a bull breakout and a swing up, 75% chance the market will break below the bottom of the channel, which simply means breaking below the bull trend line, which it did, and it could simply go sideways and then resume up, but 75% chance you'll break below the bottom of the channel. Bears, we have a double top, we have a wedge top, a lot of trading range price action here, and then we're starting to get consecutive buy climaxes. A second entry short, first is below that bull bar. Now we have a big bear bar and a pause bar. That is a short below that bar. Here we have a double top bear flag, this high, that high, and we have a bear bar closing near its low. It's an okay short, betting that we get a swing down, which we did. Wedge bottom, 75% chance there'll be at least a small bull breakout. Here we got a very strong bull breakout. Wedge bottom, a lot of buying pressure in here, and we have a failed bear breakout reversed up, and now we have a bull bar here, a bull bar here. This is the third attempt to reverse up. You can also say it's the third failed bear breakout attempt. We tried to break to the downside here. We tried again here. We tried again here. The bears are repeatedly trying to go down. The bulls are repeatedly trying to go up. The bears probably eventually give up, which they did. Here's a give up bar. The bears are giving up. Now we have a wedge bottom, 1, 2, 3. 75% chance you'll get a bull breakout, maybe a conversion into a trading range. We have a spike pullback channel, and we have a pullback testing the bottom of the channel. 75% chance we'll go sideways. 25% chance you get a bear breakout below the bottom of the wedge and a two-legged swing down. This is that 25% chance. An attempt at a wedge bottom near support, the first pullback after a strong bull breakout. Instead of reversing up above the bull channel, which it does 75% of the time, we have a successful bear breakout, which we get 25% of the time. Bears could sell the close of that big bear breakout bar, or they could wait for the double top bear flag. The market went up and then down and went up again, so now we have a double top, this high and that high, and we have a good sell signal bar here, a reasonable short there. We have another bear breakout and a pullback. This is a low one short below that bear bar. We have a wedge bull flag and got a bear breakout. You have to be thinking that it might fall for a measured move down, which it did. So this is a reasonable location to take at least partial profits. And you can see some buying here. It's also around the prior low, another reason to take partial profits. This is the S&P cash index, a monthly chart. Here's the 1987 crash. We got 3 pushes up, 1 pullback, 2 pullback, 3, and it's subdivided into a nested wedge. But a very tight bull channel. We got the bear breakout, but what followed? We failed a bull breakout here. We got a reversal down here. But the bear breakout failed here. The bears tried again here, they failed. They tried again here, they failed. We're getting a failed bear breakout below a very tight wedge bull channel. At some point, after maybe 3 or 4 bars, you have to decide the bulls have won and that we're going to get some kind of a measured move up, which we did. We have a 13-bar bull microchannel on a monthly chart. That is incredibly strong. It led to a bull trend that lasted 6 years and gained 300 points. A bull breakout above a wedge top. 25% chance you get a successful bull breakout above a wedge top. And this was one of the most successful bull breakouts above a wedge top in the past 50 years. I began by talking about parabolic wedges and how they can lead to reversals. I also talked about how strong trends are constantly forming wedge reversals, but if the channel is tight, those reversal attempts will be minor and become flags, and the trend will continue. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 5 videos on wedges. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 5 videos on wedges. In this video, I'm going to be talking about wedges that break in the wrong direction, a failed wedge. We have a bull trend here and then a pullback, and it might be a wedge. 1, 2, 3, wedge bull flag, and it tried to break to the upside, and it tried to break to the upside again a second time. A wedge bear channel, and therefore a bull flag, and it's more likely to get a bull breakout. Instead, look what we got. We got a bear breakout here and an even stronger bear breakout here. So here we're getting a bear breakout below a bull flag. Whenever the market does something that seems unlikely, you should always expect an accelerated trend, a fast breakout, and if the breakout is strong, the odds are you'll get 2 legs down. 1 pullback, 2. And whenever you're in the process of getting any kind of a breakout, you have to be thinking about a possible measured move. The top of the wedge is here, the bottom of the wedge is here. The bulls thought they were going to get a rally up to the top of the wedge. Instead, the bears got a breakout, so you have to be thinking that the bears will get the same distance that the bulls were hoping to get up here. A measured move based upon the height of the wedge. When the market falls for 2 legs and around a measured move down, the bears will begin to take profits, and the bulls will look to buy as well, thinking that the bears will take profits and you'll get at least a minor reversal. Here, the bulls tried to reverse up above a doji bar. It failed. The bears tried to resume down again, but then we got a bull inside bar, and the bulls bought above that bar, and the bears gave up above that bar. You'd expect at least a couple legs sideways to up. We got a first leg up, and then a triangle, and then a second leg up. We have a fairly strong bear trend, very strong breakout, and then a weak-looking rally. You can call it a bull channel. You can call it a wedge. There are 3 pushes up, 1, 2, 3. Does not matter that the first push up began before the bear trend ended. That's very common for a reversal or a trading range to begin before a prior trend ends. Anyway, 3 pushes up, 1, 2, and 3. Bull channel, bear flag. Odds are there'll be a bear breakout. However, sometimes you get a bull breakout above a bear flag. And when the breakout's strong, you're expecting at least a couple legs up, 1 pullback, 2, and probably a measured move up. The bears are giving up. They're hoping for any kind of a pullback so that they can exit with a smaller loss. And the bulls who did not buy initially are hoping for any kind of pullback as well, because they are eager to buy, and the result is a second leg up. Again, the bears wanted a bear flag and a bear breakout and at least a test of this low. And the bulls are expecting the same distance, but up once they got their breakout. And you can see the profit taking around the area of a measured move up. Aggressive bears will sell up there, taking a chance that enough bulls will take profits to get at least a more minor reversal down, a profitable scalp. Here's a small wedge, 3 pushes up, 1, 2, and 3. A wedge bull channel, a wedge rally. You have to be thinking bear flag, and we get a bull breakout. You have to expect 2 legs up, 1, pullback, 2. Bear trend, a weak rally, 3 pushes up, 1, 2, 3, so a wedge bear flag. Instead of a bear breakout, we have a bull breakout. The height of the wedge, here's the beginning of the wedge, the top of the wedge is here or here. You can simply call it a trading range, a bull breakout above a trading range. In either case, whether you look at it as a wedge or a trading range, you have to be thinking that traders will take profits at around a measured move up. Also, a dramatic sell climax late in a bear trend, probably an exhaustive move, and the market usually tries to get to the top of that sell climax bar. And then bulls take profits on their scalps, and bears look to sell again. The market sold off quickly when it was at that price before. Maybe it will sell again at that same price. It's a small pattern, so it's probably a minor reversal. A minor reversal means usually a trading range or a larger bear flag, in which case we did get a larger bear flag, and we also got a trading range. Bulls buying this probably will scalp because this is not a credible major trend reversal. We did not have enough buying pressure. After this, that's a lot of buying. Then bulls might buy for a swing up, higher or low, major trend reversal. This, I think, is a special type of pattern, and it's important. We have 3 pushes down, 1, 2, 3, so you can call it a wedge bull flag. However, it's mostly horizontal. This breakout is a small breakout of here. This is a small breakout of that. So it's a small breakout of a small breakout. It's a wedge, 3 pushes down, 1, 2, 3, a wedge bull flag, bull trend, wedge bull flag. When you get 3 pushes down like that, 2 lower lows, and the pattern is mostly horizontal, and the bull trend tries to resume, yet it fails to break above the top, there's an increased chance that the breakout below the bottom will fall for a measured move down. In general, if you get a breakout below a small breakout of a small breakout, in other words, basically a horizontal wedge, 60% chance you'll get a measured move down, usually 2 legs down, maybe 1, pullback 2, or other computers will say 1, pullback 2. Other computers will say 1, pullback 2. Trading range, a lot of bear bars, so good selling pressure. Lower highs, lower lows. It's a wedge, but it's mostly horizontal and the breakouts were small. Special type of pattern. If you get a bull reversal and it fails to break to the upside, be ready for a breakout below the bottom of the wedge and a measured move down. Higher probability of a measured move down from this type of wedge than from a break below other types of wedges. Small breakout here, and then a second small breakout. Small breakout of a small breakout, 3 pushes down, so it's a type of wedge bull flag. And when you start to get a strong breakout, the odds are 60% that you'll get a measured move down, a bear breakout below a wedge bull flag. Again, first leg, maybe second leg. Other computers will say this is the second leg. Measured move down based upon the height of the wedge. It's also a trading range. It fell for more than that. You can see some profit taking around a measured move down, and then it fell below it and more buying. The market's in a bull trend, 3 pushes up, 1, 2, 3. Bears will sell here, and now we have a double top, lower high. They'll sell below that bear bar here. However, if the market breaks above the top of the wedge, bears will exit. In general, 75% chance you'll get a bear breakout below a bull channel or below a wedge top. And here we did, and we got 2 legs sideways to down. 1, pullback 2. Here, the legs were sideways. Yet, we got a bull breakout above the top of the wedge. Whenever you have an obvious location for a stop, like above the top of a wedge, and the market breaks above it, hits the stop, 50-50 chance you're going to get a measured move up. 50-50 chance the breakout will fail, and the second top will lead to a reversal down. A wedge top, we tried to reverse, it failed. We're breaking to a new high, and now we're trying to reverse again a second time. Bears will either sell below this bar, or now we have a micro double top, they'll sell here. And now we have a rally to a lower high with a pair of bear bars closing near their lows. They'll sell here or here, looking for a measured move down. Strong enough breakout, second leg down, likely rally to a lower high, major trend reversal. The breakout above the wedge is a surprise. Very often you'll get a second leg up, especially when the breakout has a pair of strong bull bars like this. Usually you're going to get at least a small second leg up. And a lot of bears will wait until after the micro double top, and then they'll look to sell the reversal down. Whenever there's an obvious location for a stop, a wedge top up here, 50% chance the breakout will lead to a measured move up, 50% chance the market will try to top again and be successful. You could also view this as a larger wedge, 1, 2, and 3. Some bears know that the probability is 50% if the market gets above this high. It's 50% chance of a rally, and therefore they're willing to take the chance. They do not exit. They'll use a wider stop. And a lot of them will sell more at this high, betting that the bull breakout will fail. They know 50% chance the bull breakout will fail. Wedge bottom, 3 pushes down, 1, 2, 3. Fairly tight channel, so probably minor reversal, but pretty good buying pressure. You might get a couple legs sideways to up. An obvious location for a stop is below the bottom of this strong buy signal bar. In general, if the market hits a stop, a reasonable stop, an obvious stop, 50% chance the break below the buy signal bar will lead to a measured move down. 50% chance the breakout will fail, and you'll get a second reversal. Here we have a wedge bear channel, 75% chance bull breakout, probably a couple legs